Hello and welcome. My name is Simon French and I'm Chief Economist at Panmure Gordon. And today we're going to talk about prospects for negative interest rates around the world that since the start of the COVID-19 crisis has certainly increased in likelihood. So investors in assets in the Eurozone and in Japan will be familiar with negative policy rates. They've been around for some years now. But the slowdown, unprecedented slowdown in economic growth, the collapse in the oil price, and the exceptional response of central banks in terms of asset buying and taking down their headline interest rates in the US and the UK down to near the zero lower bound, does start to raise the question as to whether they will go negative and what the efficacy, what the effectiveness of doing so would be. It has to be said, the commentary on both sides of the Atlantic has been slightly different in recent days. We've had comments from Fed Chair Jerome Powell, which has suggested the FOMC currently is unanimous in its view that negative interest rates are not something that the committee sees as a suitable policy response. And that does suggest at the moment the FOMC see the marginal tool, if they want to stimulate the economy further, is to do further purchases of assets and move up the risk spectrum from investment grade to non-investment grade bonds, and potentially looking at what the Bank of Japan have done and start to buy into equity classes, although the latter has certainly not been confirmed. In the UK, however, we've seen increasing commentary, not just from new Governor Andrew Bailey, but also from other members of the committee, raised the prospect that the view of the United Kingdom and the Bank of England that negative interest rates were not part of their policy response, which was certainly the view under previous Governor Mark Carney, might not hold in this new COVID-19 world. And in particular, there is some analysis will be probably released during the summer in terms of the efficiency of taking the policy rate negative and trying to learn some of the lessons from credit markets, from bank profitability, from the response that we've seen in the Eurozone and in Japan. So two subtly different views. And now clearly from an investment standpoint, the prospect for negative interest rates, certainly in terms of in the bond market, has led to bonds being very well bid. That combined with almost open-ended purchases of bonds from central banks. For the equity market, of course, despite the prevalence of dividend cuts, about 50% of US companies have cut their dividends in the last 30 days. It's more like 3/4 in Europe. Despite that, that will still, the prospect of further negative or movement into negative interest rates will certainly mean that equities would be well supported despite their reductions in potential yield because of those dividend cuts. So summing this all up, COVID-19 has increased the prospects of negative interest rates. The implication for asset prices is considerable. We think the UK is most likely of the two major geographies that have not gone there to go first, but we certainly wouldn't rule out that the US may follow suit later in the year, particularly if we get a second wave of COVID-19 disruption.